Hi, I'm Jeff Hirsch. I'm here at the Seattle Money Show with Zach Johnson. He's the Senior Portfolio Manager at Stack Financial. And you guys have a strategy called, or I guess it's more of a mantra, safety first?
Correct.
How you look, what is that for? I mean, what do you call that?
So we strongly believe in this ideology of safety first, which really points to risk management. And we believe there's a key differential between market timing and risk management. Market timers tend to move more aggressively in and out of the market. We like to analyze historical market cycles and manage risk.
One of my favorite things, historical market cycles.
Yeah, exactly. And so we do that through kind of four key facets. Number one is allocation, allocation of the overall portfolio. How exposed are you to the market?
And is that the same for all your clients, or is it individuals have a different allocation?
We have two distinct portfolios, two distinct strategies. One's called capital appreciation. It's a little more growth oriented, and the other is value and dividend, which is a little more income focused.
More age-based, or is it depending upon the person's risk profile? Or
So one of the key factors we believe is if you can manage risk properly and mitigate those downside losses, you can actually hold a larger percentage of overall equities. And in our opinion, our risk profile of the portfolios that we manage tend to be a little lower risk than a pure equity allocation through time.
So what are some of those ways that you manage that risk without giving up that equity position?
And so first of all is the allocation, as I said before, utilizing cash as an asset class. We also allocate to sectors and industries based on relative valuation and conservative growth. And then finally, we really do a lot of bottom-up fundamental research when we pick the individual stocks.
So give me an example of how your portfolio is allocated, the more aggressive one currently.
So as we stand today, we're slightly under 70%. We're utilizing that 30% that is sitting in cash. We are gaining some income because we're utilizing 3-month treasury bills and actually looking to gain income for our clients.
And those are all individual stocks, about 70% individual stocks?
That is correct. That is correct.
A mix of some of the staples and defensive ones. Any aggressive growth stocks that you have in there?
That's a great question, and we do see some opportunity. I'll give you one example, Delta Airlines. Delta Airlines, we find from a valuation perspective, it's extremely inexpensive. But more importantly, from a profitability standpoint, they're doing a lot of great things. They're focusing on reducing the amount of fuel they use and also improving their planes so they can continue to add more passengers.
I've found their customer service experience has been improving over the past several years.
I completely agree with that, and that's a great point.
We flew them overseas last summer.
Yeah.
Any other highlighted stocks that you want to share with people before?
You know, one last one in this might surprise people is Chevron in the energy space. What Chevron has done to their balance sheet overall is they've really focused on cash flow generation. Over the last 12 months, oil and gas prices have fallen by about 17%. In spite of that, Chevron has been able to generate positive 2% returns, and going forward, we feel like their focus on a strong balance sheet
How
is
are
a
they
good
managing to do
opportunity.
that? Just by managing is it commodities? I mean, are they hedging and stuff? Or?
Well, what they're really doing is instead of really focusing on growth and kind of the old adage of drill, baby, drill, they're focusing on cash flow generation, and that's resulting in good cash flow for individual investors.
Excellent. Safety first. Talk to Zach at Stack Financial.
Thank you.
Thanks, everyone.